Good evening, ladies and gentlemen. Myself, Daniel, representing PMS Bazaar. I welcome you all to the new season of Emkay Alpha Mavens. And in the third episode of this season, our guest speaker will share his insights on what is inside the mind of an Ultra HNI investor. On behalf of the participants, I welcome our chief guest, Mr. Shiv Gupta from Sanctum, Vikas M Sachdeva and Sachin Shah from Emkay Investment Managers. Before I hand over to them, let me give a quick introduction about the speakers. Mr. Shiv Gupta is the founder and CEO of Sanctum Wealth, which was created through the acquisition of the Royal Bank of Scotland, Indian private banking business in 2016. Over a 25-year career, Shiv has held several leadership positions in wealth management across Asia and Middle East. Immediately prior to founding Sanctum Wealth, he was head of India and co-head of the Middle East for the Royal Bank of Scotland's private banking division. Shiv holds a bachelor's degree in economics from Hindu College, Delhi University. He is also a graduate from Harvard Business School General Management Program. Vikas is an industry stalwart with over 2 decades of experience across marquee financial service organizations. Vikas was the CEO of Edelweiss Asset Management Limited, the global CEO of Enam Asset Management Limited, one of the founding member of Birla Sun Life Asset Management Company, among others. His industry affiliations include a seat at the Mutual Fund Advisory Committee, and he was also on the board of AMFI, heading the ETF and Indexing Committee. Sachin is a seasoned fund manager with over 2 decades of experience in the Indian equity markets. Sachin realized the importance of governance early on and was an instrumental in the development of Equal Risk and MK's proprietary module, which helps the company to evaluate and compare listed companies on various aspects of governance. And also, I want to thank Finland Academy for their prize to the best questions, which will be announced at the end of the session. Finland Academy is a trading and investment education initiative. It is a research-driven, technology-oriented training and transactions organization focused on providing a dedicated education in trading and investment-related objects. Without further delay, I'm handing over the session to Mr. Vikas and Sachin. Over to you, Vikas.
Thank you, Daniel. I think one of the things you always forget is to introduce PMS Bazaar. And I think that's my privilege. Your platform is one of the finest platforms. It's one of the earliest movers in terms of disseminating information on the alternates platform. And I think since the advent of PMS Bazaar, there has been a lot of consistency in terms of evaluation of various alternate schemes. And it has helped firms like Sanctum as well as firms like Emkay to help make better choices for their clients. So thank you so much, Daniel and the team PMS Bazaar for agreeing to host us. Thanks a lot. As always, it's my privilege to introduce Shiv Gupta, the person behind the professional. Shiv, I had a chat with quite a few of your colleagues, your friends, not to alarm you, but I did have a detailed chat with them. And these are some of the things they mentioned about you. I quite enjoyed these discussions. Your colleagues and friends actually describe you as an extremely humane person. This is a very rare adjective I've heard. It's a very humane person, which according to them means you're very respectful and considerate towards everyone you meet up with. You adhere to very high professional standards. You walk the talk in every sphere of life, whether it's timeliness, orderliness, and everything. One of the consistent things I've heard about you is you have the unique ability to maintain your composure even in the most extreme of times. So I think that's something all your colleagues and friends have unanimously talked to you about. You're a voracious reader, a constant learner, and you're a big believer in frameworks and charters. You have a set framework and charter every time you see a situation and you adapt it accordingly. You've been compared, this adjective came in, you're quite like Obama, if you will. When it comes to talking teams up, charging them up, catalyzing them to reach for greater heights. And I think it was a very pleasant thing. Universally, everybody acknowledges the fact that you have a very brilliant and very wry sense of humor. At times, it's so dry and wry that very few people actually get it, but they quite enjoy that sense of humor. Your role models in life are your parents. You have a lovely family with wife Malvika, daughter Manvi, who's 15 years old, and son Kabir, who's 10 years old. You belong to a family of animal lovers. Your family was very attached to your golden retriever Nawab, who passed away recently. And currently you have 2 adopted dogs, Casper and Phoebe, right? I love the names. You're a very, very versatile sports person. You played 7 sports and captained 3 teams when in school. And even today, your team says that when you get into playing a sport, whether it's basketball, bowling, or even a fun sport, you're extremely, extremely competitive. You hate to lose even at fun sports. And here's the really fun part. And I would have never guessed this. Apparently, you have a major weakness for vada pavs. Regular human beings like me and Sachin can probably have 1 or 2. You can have 4 at a time. You can have Maggie in the middle of the night, followed by a kati roll. And people just wonder, how, and I guess being a very versatile sports person actually helps you burn it off. Last but not the least, your team says, and this is in their version of dry humor, they said that when you go about simplifying things, they have to grab a dictionary because you go very thorough risk in terms of the adjectives and verbs you use. In a nutshell, they just adore you, idolize you, and all these adjectives are theirs. I have not used a single adjective which is mine. So thank you so much, Shiv, for being on the show. It's a pleasure having you on board. So I'll just straight away set the ball rolling with questions, unless you want to say something, Shiv.
I do want to thank you for an extraordinarily generous introduction, and all the people who said all those things. You have to tell me I'm going to take them out and reward them sufficiently. On the matter of eating, I'm glad that I don't, with the kati rolls and the vada pavs, that we're not revealing midsections on this show. So that kind of helps, I think. But on the whole, to you, Vikas, and to Sachin, MK, PMS Bazaar, thank you very much for the privilege of allowing me to be here, please. Thank you.
Pleasure's entirely ours. So to set the ball rolling, we've got a series of questions which are coming from audiences. But when you're talking about an Ultra HNI, I'd just like to set the context. What, according to you, is an Ultra HNI in the Indian context? In the Indian
very good
management
question.
Context. Yeah.
Indeed, very good question, because there's so many definitions that abound and different types of businesses follow different models of segmentation. So it's good to set the expectations and clarity up front. We are going to be talking about people with 15, 20 crores or more in investable assets. But I should point out that, different definitions in the marketplace could be 10 crores and above, 50 crores and above, 100 crores and above. In the international marketplace, in fact, it's $10 million and above, which is about 75 crores, or even $30 million, which is one definition. So you can see how many definitions abound. But today, we're talking about 15, 20 crores and above.
Interesting. So, Sachin, would you like to start off your set of questions?
Sure. Thank you, Shiv. Thank you for joining us, and thanks, Vikas. So, Shiv, you set the ball, really rolling. That say about $2 million, $3 million is where we would start the baseline for the Ultra HNI, right? Of course, this $2 million, $3 million can go up to maybe $50, $100 million easily. I mean, that's the range that we have, and sometimes it can go beyond $500+ million. Also, we have those kind of large families now, at least in India, who are full-time or who are very actively looking at allocating wealth, right? Now, if you have to bifurcate this further, like if you have to profile this segment, would you profile it in terms of this, the value range, or there are some different buckets that you guys, so how do you actually, is there some way to have different profiles for the Ultra HNI?
Yeah, this is a very, very good question, Sachin, and a very difficult question, because the reality is that you're trying to find homogeneity in a very heterogeneous population, as you just described. You're talking about the wealth size, which is a source of heterogeneity, different types of businesses that people come from, different situations that they come from. So it's challenging, right? And there is no one size fits all, to be honest. But as a wealth manager and a service provider, it all boils down to two things. One is the investment profile, and the other is the service delivery framework. And I don't want to use jargon, but I'll try and explain that a little better in a minute. So the idea is that as a firm, you need to have a common understanding with the client as to how you're going to go about creating their portfolio, managing their portfolio, and delivering your services to them. So the investment profile is, I would argue, the most important part of it. And the inputs that go into the profiling process include your investment objectives, your risk-reward attitudes, your investment personality, your level of knowledge and sophistication, and in fact, the situation from which you're coming, because all of these things are influences that form your psychographic profile from which you would derive how the portfolio should be constructed. And that should ultimately find its way into an investment policy statement, ideally. The second service delivery framework part is that different people have very different styles of managing their wealth. Some people are very involved, some people are less involved. Some people like to review their portfolios very regularly, some people not so much. Some are very tactical, some are very long-term thinking. So you have to factor all of those things as well. And these two elements put together then create some buckets from which we can create a delivery proposition. I just want to say one thing, Sachin, and maybe it's early in the conversation and I should have reserved this for later, but I don't think profiling is something that we as an industry do very well, I should tell you. And this is something that, if you want to see the industry grow and thrive and clients to trust the, service providers, something we're going to have a long way to go on. There are some intrinsic reasons why it's hard. A lot of this stuff is subjective. A lot of times clients don't give you all of the information, but we have to endeavor to make sure that we carry out this activity really well at the start to create a good foundation for managing our clients. So sorry, I've gone a little bit beyond the scope of what you asked me, but I thought I'll just share everything that's occurring to me at the moment.
No, it makes a lot of sense, Shiv. But now, let me just flip the question. Okay. The Ultra HNIs or Ultra HNI family offices, they also have a option of choosing the wealth firms, right? Because there are quite a few credible names now in India with a decent track record, more than a decade, firms like yours, who have been there in the industry, who created their mark, who've actually kind of delivered and showcased to the investors that what do they get onto the table, right? So how does the Ultra HNI actually decide? I mean, and again, Ultra HNI also has the option of dividing his wealth to multiple wealth managers, right? How does he actually? What is the thought process that goes behind their mind?
So there are two frameworks that we can look at to think about this, Sachin. One is just a framework of customer value, which can apply to wealth management. It can apply to any business, frankly, and that has four components. There is functional value, there is financial value, there's experiential value, and there's social value. And the idea behind these, you can infer functional values. Does the product and service provide what it's supposed to provide as a functional deliverable? Financial values, am I getting it at a good price? Do I think I'm getting a good deal? Experiential values, do I like interacting with the service providers? Is the experience good for me? And social values, am I part of something, right? In a nutshell. And so one way to think about it is the clients will have some combination of weightages that they will provide to each of these as they drill down and decide who kind of meets these needs the best. And in the ultra high net worth segment, this is very, very important. It's not just about portfolio performance, which brings me to the second framework, which will be easier to relate to. And that is about what is the customer's value curve? What are the things that they will look at when deciding who their wealth manager should be, right? So they look at, very important because it's a relationship-driven business, the relationship manager very often. They will look at portfolio performance, quality of advice, breadth and depth of the product platform itself, the technology behind it, the service. They look at all of these things in some ranking, which is not the same for everybody. But they will put all of these things together and then decide who they want to deal with. And accordingly choose. Many a times, they don't know all of these things about the firm that they're going to deal with beforehand. So they have to obviously rely on testimonials and people from within the network who might have dealt with someone. So a referral from an existing client is also a very big source. In fact, 60-70% of our business comes from referrals from existing clients.
Wow. Okay. So, I know just one related thing. I mean, you partly probably already addressed it, but you get a little more on a detailed side. So do clients also consider the kind of the knowledge, the research, the technical capabilities that the wealth manager has, and are there any specific parameters that they would actually evaluate to engage with the wealth manager?
It's a good question. I would like to think, Sachin, that there is a baseline that any wealth manager that they will deal with needs to have. And above that people can be relatively better or worse at certain aspects of it. So what I'm going to do is define the baseline the way Sanctum thinks about it, the way we think about it, right? On the knowledge, research, technical capability. So we are we are providing an end-to-end investment proposition to clients, which means advice, execution, custody. So our platform should be able to deliver all of that. We cover all the asset classes. We cover all the investment styles, fundamental technical analysis included. So we're looking for the entire value chain of advice, which starts with taking macroeconomic views. So you need to have that research capability. You need to provide a strategic asset allocation framework. So you need to be able to have the analytical capability to provide that. You need an ongoing tactical asset allocation framework, which you need to have a model for. You then do routes to market analysis, security selection, manager selection, and we're in an open architecture, so it involves a whole bunch of research on what the whole ecosystem looks like as well. And like I mentioned earlier, covering fundamental analysis, technical analysis. So, a good way to relate to this point is that we have a 105-member team at Sanctum, and we have 25 specialists, which includes portfolio managers, dealers, investment advisors, market specialists in equities, fixed income, structured products, etc. So this is how I think an end-to-end baseline of the kind of knowledge, research, and technical capability high-quality wealth management outfit needs to have for this client segment.
Understood. Yeah, that's very helpful. Thanks, Shiv. Vikas, I'll hold on to
I was just listening very intently. One of the statements which struck me, I think Sachin actually exclaimed, the amount of business you're getting through referrals. 65 to 70% of your business you see is coming through referrals. That's amazing. I don't think I have heard a number like that in quite a while. So my congratulations to you and your team for that. If I flip back to the client, obviously, clients are referring you to others, but how involved are these Ultra HNIs in understanding the investment process? On one hand, my experience has shown that when I talk to some of the Ultra HNI clients, they say, Vikas, why don't we just meet once a year? Because an hour I spent with you is an hour I could give my business, and that will actually generate a lot more returns. To a client, on the other hand, who wants to call me, every time a stock is purchased or sold because it reflects in his DMAT. So, what is the predominant rate in the Ultra HNIs? Do they simply leave everything to a wealth manager after explaining their goals, or do they try to control a lot remotely?
I think you already answered the question, because I will draw your attention to your own experiences where there is someone who will create a portfolio and just leave it to be reviewed every 6 months, 1 year on the one extreme, and on the other extreme, someone wants to talk to you every day or several times a day for that matter as well. So the reality is it's very hard to generalize this, right? And all of these things can be thought of as a normal distribution. Most of these things that we discuss in terms of attributes can be thought of as a normal distribution, but you've got plenty of observations coming on both sides. It depends on the investment philosophy of the client. Some people tend to have a more active investment philosophy, others more passive. Some people tend to believe that you should do things tactically, opportunistically, rather than just creating a long-term asset allocation profile. Some people like trading actively. And this is an important insight, Vikas, that we have all of these types of people, right? It's just, so the platform has to cater to all of these types of people. So back to the specific question, you have a range of observations on how involved people get from very hands-off to very, very hands-on. The two interesting things I will say is, particularly as you go to the higher end of this segment, you are starting to find that, the people who have family offices, or people who they might employ, sometimes between the client and the wealth manager, there is an intermediary, right? Then there is a delegated involvement, and sometimes those people can be a lot more involved than the principal client himself, because there's two levels separate, right?
Okay.
You get observations like that, but in general, if I think about the wealth management landscape in India over the last 15 years, 20 years, the desire on the parts of clients to understand risks, to understand the features of products and instruments and markets has been getting higher and higher, right? People are getting savvier, more sophisticated. In general, I think the baseline's been rising over this period. And therefore, the quality of the questions we get right at the outset, the involvement in having a conversation on the profile, I think is higher. It's been going up.
And I dare say it also depends on the overlay the market is at that point of time. If the market's undertone is bullish, then maybe lesser questions. But if the market undertone is bearish, then maybe more questions. I'm just generalizing, but am I right in that?
You're exactly right. We call a bull market a random market event where we all feel like investing geniuses, right? And
True, very true, very, very true.
Right.
Yes.
And time horizons become longer, and whole behaviors change. And this is the interesting thing, because we talked about the client profile before. There is and pardon me for this Tharoor-esque thing, but there is a metacognition issue there. A lot of times we don't know what the profile is because the profile itself keeps changing. So the client himself doesn't know what it will be. There is a second order effect taking place there. And I'm only saying this because you're saying there's a bull market. So the client's profile itself should account for the full cycle, bull markets and bear markets, but it doesn't always. You see different behaviors in different kinds of circumstances. So
my next question is actually a combination of several small questions. So you'll have to be a little patient till the time I finish that off. A lot of people have asked what are some of the preferred international investment avenues Ultra HNI has explored in terms of both instruments as well as countries. Do they go in for managed equity, or do they go in for, say, index investing when it comes to international markets? And in general, what is the allocation to international equities? This is more around global equities. So 2 or 3 questions in one.
But it's good because I wrote an article recently for the Bombay Brokers Association on international equities. Okay. So this helps quite well. Thank you for asking it. So look, I think the 2 primary routes are, of course, feeder funds and LRS platforms. And whilst it's overall still quite small, both have seen what would be called exponential growth in literally over the last 3-4 years, right? I believe feeder funds have grown to some 42,000 crores, which is still quite small, but the growth has been huge, and I suspect it's going to get bigger. Plus, you've got the government encouraging platforms on Gift City, and the NSE, BSE setting up platforms there. So I think both routes, feeder funds and LRS routes, which are the predominant routes, are growing. Those are the 2 routes. Many platforms are coming up, as I said, from international markets as well, which are digital for the LRS route, and we've seen quite a lot of adoption of those kinds of platforms as well. We have a couple on our own in our own product suite. So far as countries are concerned, I think that was the second question. US is overwhelmingly the most preferred country. I mean, I was looking at some market data, because I think even in these feeder funds, I think 75% is the US. Although when I look at the data we have of our clients investing through us, that number is closer to 50%. So maybe because the market data covers everybody, maybe at the ultra high net worth kind of level, it's a little bit more diversified than that. You find a bit more of Europe, you'd find some more Asia, some more thematic stuff as well behind it. But on the whole, the US is overwhelmingly represented in this allocation. Overall allocation is still quite small. 3%, again, I was looking at some data, 3% of equity AUM. Last year, I think 5% of LRS flows, which is equity and debt, are what are international investments. We would normally recommend 10 to 15% as a start. But the numbers are much smaller than that, I think, at the moment, but it's growing. So far as active versus passive is concerned, there isn't good quality data to look at, because I think to a degree, it will mirror the active versus passive debate overall. So people who believe in different degrees of market efficiency might lean one way or the other. But what we can infer from the same data is it's at the moment about 80-20 in favor of active.
Interesting. Very interesting. 80-20. I would have never guessed. I would have thought it was probably the other way around. Very interesting.
But, on a small base at an early stage, so I think we must caveat that at the moment. Over a period of time, it's also constrained by the supply, and certain other structural factors. And so as these things develop a little bit further, maybe this number can change. This may not be a good representation of what it could be in 4 or 5 years. I suspect it will mirror the overall debate on active versus passive and kind of which way it goes.
Interesting. And, just one added question to that. The global counterpart of an India Ultra HNI, whatever way you want to define it, in terms of his asset allocation, would he probably have as much real estate as what an Indian Ultra HNI has, or the similar asset allocation as an Indian Ultra HNI would have? say Ultra HNI? Ultra HNI sitting out of the US or
On
Canada?
real estate, that's a very
Real
interesting
estate.
question. I think it's affected by geography quite a lot. Parts of Asia and India, and I'm saying this because of my international experience. I was working in
That's the reason
international
why I asked
market
you,
for more than a decade. It's much less in Europe. In places like Asia, China, India, where you've had sort of structurally constrained economic circumstances, right? In going back 20, 30, 40 years, where real estate was the only real inflation adjusting asset class and the only real source of wealth, that there was a disproportionate representation of real estate in their portfolio. So in large parts of Asia, you find real estate as much as 50, 60, even 70% of portfolios. Europe is much less. Again, this is anecdotal, much less. And US is probably somewhere in the middle. I did want to add something to what you said, Vikas, on international investors. We were talking about Indian investors and their investments in international equities. Even globally, there's something called a home market bias. So most investors tend to invest much more in their home markets. And even in a place like the US, for instance, the equity portfolios have only 15% in international equities. So that's just an interesting perspective I thought people might want to look at.
This is also at an Ultra HNI level. I would imagine that an Ultra HNI would have a little bit more exposure, but amazing.
Maybe, but around that number, I would think.
Amazing. That's a very interesting statistic. Sachin?
Yeah. So coming back to home, in the sense that at least the perception, Shiv, and which is where I would like your understanding in clearing the myth. The perception is that the Ultra HNI is a high risk taker. Is that so in your experience with your families or the Ultra HNIs that you manage?
You use the word myth, right? So I think there is something myth-like about this. Look, we can understand why. So the answer is I don't think so, but I will give you some background here. I think we can see why people might think that, right? For one, ultra high net worth individuals, particularly at the upper end of the wealth segment, are entrepreneurs, right? Overwhelmingly entrepreneurs. The proportion is very, very high in favor of them. And therefore, they're risk takers, right? They've taken risks in their businesses. They've concentrated all their wealth in their businesses. They've taken chances, etc. So they are, of course, risk takers in that sense. Also, when you have larger corpuses, you have the ability to have a larger number of higher risk instruments within your allocation, right? So you could have many more AIFs in the form of VC funds, PE funds, or even direct investments in companies. Again, these are higher risk investments. So you can understand why people might have this impression. But in our experience, when you start looking at this at a portfolio level, and then you plot the universe of all the different asset allocations you see, I think we find a normal distribution. And with that, the balanced asset allocation profile is probably somewhere in the middle. That's where we are. Many clients also feel that they're taking risks in their business on a continued basis. Therefore, the corpus that they've set aside in liquid assets ought to be slightly less risky. And so it, in fact, starts resembling a barbell in some cases too.
And do they try to look for a balance in terms of either by way of concentration or diversification? How do they try to, what is their perception towards that? And how do they actually act on it?
So again, I'll be caveating all of these by saying there are so many different observations, and we're trying to find some general insights in between those. It applies to this point also. Look, I think first, because we talk about diversification and concentration, I want to make 2 points just to add a little color to these two words. So first, diversification is diversification across asset classes, across geographies, across styles, across instruments, across numbers of securities. So when we start looking at this question, you have to kind of account for all of these things, right? But of course, at the top sits asset class, and then other things fall later in the hierarchy. And then on concentration, again, I go back to the point I was making earlier that many of these people are concentrated in their businesses, right? Heavily concentrated in their businesses. Just remember that there is concentration, but it's in the businesses. And that probably has some impact, at least to the people who see this, who are in that situation, in the way they might think about their investment portfolio. So, bearing in mind these two aspects, I think the distribution has a skew towards diversification or even over diversification. I was asking my market heads recently, what are the most diversified portfolios you've seen in the last 10 days that new clients have come to us with? We got one in Bangalore, 40 crores in 52 schemes. Another one in Bombay of 60 crore portfolio with 220 stocks. Now, Sachin, you're an investment professional. You know what the rules of thumb are around numbers of stocks or numbers of funds and so on. And these are not those numbers, right? Those numbers are much less. So, and it's interesting sometimes to think about why this might be the case. Earlier we were talking about the place being multi-banked, right? It's a competitive environment when people are dealing with many people. So you have, on average, ultra high net worth individuals could have 3 to 4 different relationships. Right. So that results in some of this over diversification. Sometimes people just buy things product by product rather than looking at it holistically. So that results in this diversification. Sometimes there is a base rate neglect element that takes place where someone made money over the last 7-8 years, and 7 years ago they used to allocate 20 lakhs to a particular investment because that was the right proportion at the time, right? And in many cases, they haven't updated the base rate themselves. So even now, you might find a 100 crore portfolio with a 20 lakh allocation to something.
Sure.
So these are the kinds of things that are influencing this, but we are seeing more diversification than concentration. More recently, you're starting to see conversations around measured concentration as a means of generating alpha. So you're starting to see some of that also. But mostly it's more over diversified from our point of view.
Yeah, absolutely right. And I think that is where people like you will actually add a lot of value to these investors, because if they're so overly diversified, I don't think they can do anything better than markets, right? They will actually be probably below markets most of the times. Best case, they would be in line with markets, and that is where they need to get. And actually, the point is that it's not about it's about concentration, but it's about being focused. So that is what we internally talk about, that we need to avoid concentration risks. But at the same time, you need to have a focused portfolio with your allocation disciplines. And I think that is what investors will probably, and that is where some of these investors have missed that point, right? When you have 52 mutual funds and if you have 220 stocks, you've completely missed that, but there is no focus, absolutely no focus.
So Sachin, I entirely agree with you. And I go back to the last point I made, that increasingly we're starting to see clients who are thinking about measured concentration. So like you said, focus, right? There is a point, if you wanted to create a quantitative model, that you could find an equilibrium where 8-9 stocks well chosen could kind of get you the kind of alpha that you're looking for. And anything north of 20-30 is anyway pointless, right? So there is a move towards that. We're starting to see some people talking about that, actually applying it in their portfolio. Same for managers. Why do you need 20 managers? So let me just find the top 4 or 5. So the conversation direction of travel is absolutely in the right place.
Right. Great. Thank you.
Very interesting.
Yeah, Vikas.
It's very interesting. While you were talking, I was making some mental notes. I think Sachin also caught on to those 2 data points: 220 stocks, 52 schemes. I think this was like sore thumbs just stuck out. Just made a mental note of talking to my wealth manager after this conversation once again.
Are you going to reveal how many mutual funds you have in your portfolio, Vikas?
7.
Okay, Sachin.
And none of them large cap.
See, now this is measured concentration.
Yeah.
This is an example of measured concentration. How about you, Sachin?
So honestly, I don't have any active funds. I have only index fund. I mean, just one index fund, and all my other money is in our PMS and AIF.
See, you actually asked a question about mutual funds. That's why I answered 7.
Yeah. Otherwise, you would have
overall equity. I would have said that almost my entire money is with my own schemes and a little bit in equity. So yeah, but in terms of asset allocation, I'm lopsided towards equity.
And
no,
but increasingly you're talking to a lot of people, and this is also showing up particularly the more sophisticated clients, they and professionals, fund managers, etc., who are over allocated to equities. I am also, because they take a particular view of A, the risk-adjusted returns available from equity, and B, the India opportunity and what the next decade kind of looks like. So I thought I'll just make that observation.
In fact, talking about observations, before my next question, I'll just share an observation. It will put into context my next question. A few years ago, maybe this was 7-8 years ago, I was at a forum wherein there was this gentleman, a young gentleman, who had sold off his startup and made a lot of money. Okay, and as is my want, I said, let me just approach him and see whether he'd like to invest with us. So when I went to him and I said, you should invest your money in equity. This is a startup guy who sold off everything, right? So he just looks back at me and he says, why should I invest in capital markets? I would rather invest in the ecosystem and create many more people like myself. That will help benefit the entire country. And it was a very refreshingly different, sort of a thought. He was a first generation Ultra HNI, if you will. So the question I actually wanted to ask you is there a behavioral difference between, people who have who are first generation Ultra HNIs vis-a-vis quote unquote vintage Ultra HNIs? Do you see a behavioral difference across some parameters with these guys?
This is a very vibrant conversation points at wealth management conferences, by the way, because stereotypes of this abound, right? Popular literature is kind of awash with stories of the wastrel inheritor, right? Who doesn't have the same motivation as the previous generation. There is that proverb, that cliche, shirt sleeves to shirt sleeves in 3 generations, right? Which says the first generation makes the money and the next generation kind of keeps it and the next generation sort of loses it, right?
Yeah.
And of course, it's found its way into myth to an extent, because a lot of this relates to family businesses. And over the years, many of them have taken concerted efforts to kind of systemize the way they think about these things. So I want to move on from these stereotypes. Again, you can't generalize, but some tendencies can be inferred, which might at least correspond to some parts of the populations of the older wealth versus, say, newer wealth, right? People, for example, who've had wealth for longer tend to have thought about issues related to wealth management, estate planning better. In many cases, families would have set up systematic approach to thinking about family capital. Family capital means human capital, I mean. So, all the people in the family, the money of the family, who's doing what role they play. So there tends to be a little bit more of a systematic approach with older wealth. Newer wealth are kind of getting their heads around all of these things for the first time. Entrepreneurs, on the other hand, new entrepreneurs tend to be bigger risk takers. So again, it's a generalization, but I think it has some support behind it. But ultimately, when it translates to portfolio management, aside from what you just said, Vikas, and we can come back and discuss that a little bit more, psychographic profiling ultimately drives investment behaviors. And there you'll find plenty of commonalities between people from one category or the other, aside from these differences that I just stated, right? So it's more, you often find a second generation guy whose investment profile is much more than like the new money guy than within his own segment. So I just want to say that some of these observations have some limited implications. The good news, by the way, I was reading somewhere where globally, I think 65 to 70% of ultra high net worth investors are self-made, right? And a fair split between professionals and entrepreneurs. So it's an interesting point there. But that's how I would think about this, Vikas.
Wonderful. That's actually quite insightful. One of the key things we keep hearing, from people, again, this is probably part of myth, but I'm just asking this because you deal so much with these sort of investors. The actual time horizon for investment for somebody who's an Ultra HNI vis-a-vis somebody who's an affluent investor, time given to an investment option to fructify, is it different for somebody who's more of an Ultra HNI? And I'm just taking aside the variable of needing the money, assuming that both can invest for reasonably long periods of time. Is the time horizon for an Ultra HNI higher than that for an affluent investor?
Yeah. Well, because controlling for that variable, it's very difficult to infer this, I should say. Because again, you have long time horizon people and on both ultra high net worth and on the affluent side, and people with short time horizons on both sides, right? Now, of course, again, some of the points that we were talking about when we were talking about their risk appetite, that it would appear that they have a higher risk appetite, also apply to the tenor. So, if you have more money and a higher corpus, the ability to have instruments with longer tenors in your portfolio is much higher, right? You can afford to, if I have 150 crores, I can have more PE and VC funds in my portfolio, which may have lives, of as much as 6, 7, 8 years. Of course, the cash flow life is probably a little shorter, but generally that's a good number to work with, or even direct investment. So you'll find many more of these in their portfolios. And so that might also give an impression that they can have a longer time horizon. But I want to make 2 more points. One, many clients have a very compartmentalized view of their portfolios. So at the portfolio level, I don't know if the time horizon is longer. There's some parts of it which are and some parts of it which are not. And the second goes back to that bull market point that we were making, right? In practice, anyone can say anything, but in practice, our experience suggests that nobody really has a longer than 3-year time horizon. We've been sitting on a secular bull run, as you will agree, Vikas, the last several years, right? With some disturbances in 18-19 and very tiny disturbance at the start of the pandemic. Those were enough to see behaviors from sophisticated investors who made decisions which would suggest that they're not really long-term investors. But for the most part, we're not seeing so much. We don't see long time horizons. It's not our instinct that people have such long time horizons. A very small proportion of the population actually have long time horizons.
Very counterintuitive, but very interesting. Thank you so much for sharing that. In fact, I was just looking at my screen. It's already 45 minutes into the conversation. Didn't even realize how time has gone by, and a lot of audience questions are coming. So I'm going to ask Sachin to just ask a couple of more questions before we then move on to the audience questions. Sachin?
Yeah, I'm definitely now the last.
If you like me to give shorter answers, that's also okay.
No, not at all.
No, please.
In fact, I must tell you that one of the comments which is coming in is it possible? Sachin is asking us, is it possible to share the recording? This session is a wealth of knowledge. So I think we are doing some right things here. Don't worry about it at all.
Sachin, so actually, that brings to me a very, Shiv, you were mentioning about the time horizon that the investor is looking at, say, in reality. I mean, they may say everything, but in reality, it's just about 3 years and your time bomb is ticking, right? And frankly, we do face that, at least when it comes to equity portfolio. But ironically, right, the same investor who has made an investment on his own in real estate, and real estate hasn't given any return in the last maybe 6, 7, 8 years now, right? Or say even for that matter, if you look at, say, the debt markets, right? So, do they really think this is a part of their asset allocation? Has that now, because earlier real estate jo hai, wo to hai, it was like those kind of things. At least with
बहुत बढ़िया question है ये, Sachin. I think best question prize के contention में आप हैं इसकी वजह से. इसमें एक बहुत interesting nuance है. मैं बताता हूँ. Let's look at it as 2 questions, Sachin. One is, and let's set gold aside, and other physical assets, just real estate. Let's talk about only real estate. Not that you've asked, but I'm saying, think real estate only. That what part of the allocation is in real estate in a typical ultra high net worth portfolio? That's the first question. Second question is whether they consider it part of their asset allocation, and it's not the same thing. So real estate is overwhelmingly overrepresented in portfolios, right? You can see this from the market level data itself. You don't even have to go client by client.
Right.
Kabhi to, you'll find someone with a 500 crore portfolio where 450 is in real estate. We even have examples like that, right?
Absolutely, yes.
And you can see why also, because if you thought about the investment options that were available, as we were discussing earlier, over the last 4 or 5 decades, right? There was a time at which this would be the best asset class. If you think about, all the options that were available, where inflation was, where other instruments were, and so on and so forth, where the economy was. So, okay. This has been changing, of course, dramatically for a variety of reasons. Aap RERA boliye or any of the other structural changes that have taken place that have tried to address the leakages because of which real estate used to have a distorted level of interest in the minds of many people, right? That has reduced. And then people have actually empirically, you bought something 7, 8 years ago at the premium end of the segment and you've not seen it go anywhere. In fact, it may even have fallen for many people. So very high representation, but reducing, certainly reducing. I think this is definitely a trend. Most clients don't see it as part of their asset allocation. And this is one of the big challenges for and that's why I'm saying, your question is very nuanced. So it's a very big challenge for us as wealth managers, because we try to always, and anyone watching the show, anyone who's ever asks me would say, you have to look at your entire asset allocation altogether. You may choose to manage portions of it in whichever way you like, but you'll be doing yourself a great favor if you looked at it all together. And a very large number of clients don't. And I think that's just leaving a lot of value on the table, if you ask me.
Yes. I'll just make one point there. So since you said that to all the audience, so and please correct me if I'm thinking wrong. So when we talk about real estate allocation over here, we are talking about the real estate which is over and above the real estate that you own for the personal consumption that you have. So the house that you're residing, we don't talk about that as the allocation.
Yeah,
but
that's a very good
over
point.
And above that is part of your asset allocation, right?
Very good point. That's in fact that it's called a dwelling house exception, that you exemption, even in tax it's looked at like that globally. That take out your one main primary residence and then look at everything else.
Absolutely.
But of course, here we talk about ultra high net worth individuals who will have like 7 properties in addition to their liquid portfolios.
Yeah, and maybe 3.
But again, it's changing. Structural changes are changing that.
Right.
You had a second question on debt. Sorry, go ahead.
No, please go ahead for that. Yes.
No, I was done. I think you had a second question on debt. I wanted you to repeat that if you could.
Yeah. So actually, I'll just, in the interest of time, I'll combine it along with gold. So with gold and debt also, right? Do they look at it as a because generally when equities don't do well or real estate don't do well, these are risky assets, whereas the risk-free assets considered to be the debt. I mean, debt is not exactly risk-free. I mean, what the kind of the things that we've seen in the last 10 years with at least the DHFLs of the world and all of that, but still, or ILFS of the world, but still debt is considered as a more of a risk-free, and gold is probably also that. So how do they think of allocating that part of the money or whatever allocation is to this two assets? Is it to balance? Is it to reduce the volatility? Or how do you actually advise for these two assets?
Yeah, I think I'll answer the second question because that will make it easier to think about it from the point of view of an allocation, right? We think of these as components of an asset allocation. So if you tell me, give me a strategic asset allocation for a balanced investor, I'm going to tell you it's 40-40-20. 40 is equity, 40 is debt, and 20 is alternatives. And I'm just using a rule of thumb version, right? Otherwise, it can be, of course, more complex than that. And 20 will be alternatives, right? So debt plays that role, and it is expected to provide a particular risk-adjusted return. And therefore, at a portfolio level, you're expecting in this balanced portfolio, maybe 12% returns, 13%, depending on which country you're looking at and where interest rates are. And obviously, you would expect volatility to be dampened because of debt in the portfolio, not only because it's less volatile, but also because it's less correlated, right? And the same for gold, where at the onset of an inflationary cycle, you might increase your allocation even further. But Sachin, you said something very interesting to which I want to respond. The perception of the risk in debt investing. See, debt has a whole spectrum of investments from investment grade to junk, right? And traditionally, the credit quality mechanism, the rating mechanism, the manner in which credit gets allocated to the economy was distorted. You can't say wo single A rated company actually single A thi. If you actually went down to any global standards of establishing, analyzing the credit worthiness. So I think that it's sad that a lot of people have a particular perception of debt as being very, very risky, which was a result of a distorted situation before, which I think has been cleansed to a very large extent. But I thought it worth making that point.
Sure. No, it's very helpful. Just Vikas, I'm sorry, but I can't leave Shiv. I have to finish my quota. So
no problem. In fact, Nikhil from the audience actually asked this question. So I was very happy to let this go. Where do HNIs, Ultra HNIs invest in debt? Since many a times they themselves have riskier sources for fixed income instruments. I think in a way you've answered that. There are 2 questions I'd like to ask, and then if I have time, I will ask some more. A lot of comments and compliments are coming in. I'll wind up with that. But one of the questions is, what is the global trend? This is Manohar Peravelli who's asking this question. What is the global trend in the strategic allocation of funds in between listed and unlisted investments as done by Ultra HNIs?
So, a very good question, Manohar. Manohar.
Yes.
The trend is for it to increase, moving towards an increase, most certainly, towards unlisted, more unlisted. And I think some of that is also a feature of the environment we find ourselves in from the point of view of low interest rates. Also, the startup, sort of the startup boom that we've been seeing for the last 8-10 years, right? Which has made a lot of people directly take a lot more interest in unlisted investing than before. The amount of capital that's going into PE, into VC, exploding. It's actually exploding, right? In India, by the way, you talk about global. I just in India, last year, I think the PE VC corpus crossed $150 billion. Right? 4-5 साल पहले तो मतलब पता नहीं 1/10 भी नहीं हुआ होगा मेरे हिसाब से. And it is funds, it is direct investing, of course, for ultra high net worth. It includes both types of investments. And I think globally it's also the case. I read somewhere a few months ago, for example, that the Yale endowment has something in the nature of 30% or something like that in private investments. So somewhere in the 30-35% type of a range. So I hope that gives Manohar an answer that he can live with.
Absolutely. This is very insightful. Test VK is the name. And he says, great conversation. I'm assuming it's a he, I can't make out. Great conversation, questions as well as responses by panelists. 2 points to ponder. Point number 1, is everyone ready to pay fees if they're generating the same returns on their own? So this is, I think, a quintessential DIY question which is coming in, DIY investor question which is coming in. And the other one, which is a little more interesting, if all tax saving avenues are gradually reducing their exposure to equities apart from section 54 and 54F, what will the investors do once interest rates start moving up?
Okay. The second one is a slightly more complex question. We'll come back to it. And my strategy for dealing with complex questions is to give extremely simple answers, by the way. So I'll come. I think maybe we should just start there.
Sure.
Look, I think, whenever someone goes into the investing activity in general, they should think about the larger picture of which assets they're allocating their assets to. And what are the risk reward and time horizon characteristics that would make it a successful investment. And if you're investing in equities, all of these details are one thing. You invest a portion of your assets that you think corresponds to your profile to invest in equities and take a longer term view and don't bother about other stuff. That's how I would think about it. I'm sorry if it feels like an escapist answer, but that's really the best answer I've got.
I think the simple answer is the best answer. Yes.
Right. And that's it. That is the avenue. You would still be expecting equities to give you. In India, if you look at the last 4-5 years, the equity risk premium is running at 8-9% or some number like that. Right. So that's a pretty good number. I think globally it's 5-6-7%, for example. So I think, that it remains a very interesting avenue, notwithstanding any of the other elements. So far as pricing is concerned, it's a very complex subject. And every wealth management conference will have a lot of people talking about clients pay, don't pay. Look, I think there is a perception that clients are price sensitive first. And I'm making that point not only from a do-it-yourself investor point of view, but in general, I'm saying. But they're price sensitive. Plus, it's a very competitive marketplace. So there is a tendency for people to start competing on price as well, which further drives down the propensity for someone to pay, if you will, right? But I think at the heart of this is where does someone find value and are they willing to pay for it? And that is a more mixed picture. And in this case, when I say mixed, it means a positive picture. You'll find plenty of examples of people who genuinely realize that investing is a far more complex thing. You need to take a few simple steps, but it's far more complex when it comes to managing your psychology, managing the noise, seeing yourself through a cycle. And for that, you need good advisors. It will sound like I'm saying this because we are advisors, of course, and that is also true to a level, but we genuinely believe that you need good advisors. And for that, it's worth paying, according to me. At the level of ultra high net worth, of course, there are many, many more things we do that would justify why someone might pay, and people who see value do end up paying. So that's how I would kind of just address that question.
In the interest of time, I'm going to take two quick questions, but I will just request the audience. A lot of questions, Shiv, are coming in terms of your advisory style. What is the minimum ticket size you will take? How will you manage portfolios? So I would request you to write into PMS Bazaar. There's an email ID. Daniel can give that to you. And we will forward all of these questions to Sanctum, where Shiv and his team will want to answer them, customizing their answers if you will. Shiv, I hope that's okay because a lot of questions are coming in, in terms of your advisory style. I hope that's okay.
Yes, of course. So
PMS Bazaar is becoming one of the referrals for him.
Yeah.
Right.
So the two questions here, the last two questions which I'm going to take. In fact, Mr. Subramanian, there is a question you've asked about the future of HDFC Bank post-merger. I think it will take one whole session. And I don't think, we have the time or the inclination to answer that. So my apologies. We will skip this. Viral Bhuta is asking about, can LRS route allow allocation to overseas US private equity pre-IPO deals? That's the question. Can LRS route allow allocation to overseas US private equity pre-IPO deals?
Yes, I think it's correct. It can.
Okay.
This information can be easily verified on the net as well, but I should think it can.
Okay. The last question is more of, it's a slightly offbeat question, but I think it's relevant, which is why I'm bringing this up here. The question is asked by VP, that's the name of the person. And he or she says, my question is from an industry perspective. Many new aspirants are entering wealth management business. How do you see this industry evolving for new players, the wealth management business? New guys coming in with all the qualities and expertise to advise and serve to this segment don't have too much of legacy, of their own to serve clients in their books. What would be your expert advice as an industry stalwart to such players? And what should they be doing to target such clients?
It's a very good question. This is the kind of stuff we ask ourselves sort of when we have our strategy sessions, etc. Look, I think I'll make 2, maybe 3 points. One, the size of the pie is very large, really extraordinarily large from where we are today. A few years ago, you couldn't find, $500 million in AUM would be mid-size kind of wealth manager. Today, that number itself must be 3-4 billion, right? So that much you've seen. And we haven't even scratched the surface yet. Different reports suggest that India total wealth, which may be a multiplier of GDP, say, is, if your GDP is 2.5-3 trillion, then if your total wealth is 7-8 trillion. And organized wealth management itself could be a fraction of that today. Plus, you've got anywhere between 200 and 300 billion dollars coming into household financial assets every year. Where's that going to go? Right? So there's so much scope for growth. And then financialization taking place makes it also very much more interesting. So there's scope for a lot of people to play. First point. Second point, depending on the size and nature of the firm, how focused you are versus how sort of broad-based you are from a product services point of view, geographic coverage point of view, your strategy will vary, right? Depending on kind of where you see yourself. So when we look at new wealth managers, there are both types coming in, and we would say different things to different people. Eventually, we will find, and by the way, the US market is a very good market to study for this. So US market has a very large number of mega large wealth management firms, mostly through their big banks, right? A lot of specialist wealth managers, which are very, very large national, and a thriving industry of IFAs and independent wealth managers. And when we say IFA, you're not thinking about one person sitting in a corner somewhere. You're talking about people who manage $2 billion, $3 billion. So my advice to anyone is to be clear where you want to play, but there is a lot of scope. Be sharp in your thinking. How will you win? Where do you want to play? How will you win? What form do you want to take? Have a long runway. It's not an easy business to build very quickly. You can get lucky, but it doesn't really build up that quickly. People mistake that sometimes. Have a long runway. And at some point, you'll see the inflection point. And so that's what I would say. And I wish whoever is thinking about this good luck.
Wonderful. So if you have to decide on the winning question, the prize winning question, do you think that Sachin? Okay.
Just kidding.
I thought this question which somebody asked, I think Test VK asked about tax saving avenues gradually reducing inequities and what are the investors going to do once interest rates start moving up. Would you want to give this gentleman or this lady the prize, or is there any other question you have in mind?
No, let's give this person the prize and congratulate them.
And she's going to take me out for dinner for my prize.
Done.
No, this was amazing. I think we had a lot of participation, a lot of compliments coming your way. In the interest of time, I have not actually mentioned quite a bit, which is why I said they should directly come into you, but people have appreciated that. Recording of this is going to be uploaded on YouTube after PMS Bazaar curates it. So thank you so much, everybody. Thank you, Shiv, for being on the show. You've been a great guest. Thank you, Sachin, as always, asking all those questions. Daniel, thank you so much for this amazing platform. And thank you for the audience for participating in such large numbers and really encouraging us to do better. Thank you so much.
Yeah,
thank you so much, everyone. Absolutely.
Dear participants, you can write your questions to events@pmsbazaar.com. So we'll get answers from Shiv and share it across with you. And once again, thanking all the participants and the guests for this insightful session. Wishing you all a very happy and safe weekend. Thank you very much.
Thank you very much, everybody. Good weekend
Thank
to you
you.
all.
Thanks. Bye-bye.
Bye-bye.